Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool. I am now going into being more than halfway done with this series where I look at the 20 sectors covered by FactSet Research Systems. This is the 11th sector I've covered, and it's the health technology sector. And it's essentially companies that, are in the healthcare industry, but based on various technologies. So we have things like pharmaceuticals, both major and generic. We have biotechnology. We have miscellaneous companies that sell medical specialties to the industry, etc. But I've only got 10 candidates I'm going to be covering in this article. They are Abbv, Allergan, Amgen, Biogen, Bristol-Myers, Celg, Gild, Milan, Pfizer, and Perrigo. And as you can see here, these companies are really quite diverse. They range from being AA rated in the case of Pfizer all the way down to BBB minus with Perrigo. But they're all considered investment grade companies. When you look at based on size, you're going to see that the largest by market cap is Pfizer, followed by Abbv, which again, these are two large major pharmaceutical companies, and then Amgen, which is the largest biotech company, followed by Gilead and etc. So you can see these companies are quite diverse. From a standpoint of dividends, 3 of these companies are pure growth stocks that pay no dividends, and the other 7 pay reasonable dividends, from Perrigo at 1.6% current yield, all the way up to Abbv that currently offers a 5.46% current yield. So we have quite a diverse group of companies here that I'm going to be covering. And since I'm covering 10 companies, I do want to make it clear that these are research candidates that I'm suggesting if they look attractive to you, you might want to go ahead and dig deeper into them. They've not been thoroughly researched in most cases by yours truly. I'm simply offering them as companies that look attractively valued in this particular sector. The first research candidate that I'm going to take a quick look at in this particular sector is the biotech behemoth Amgen. It's a $116 billion, almost $17 billion company. Its total economic value is $124.7 billion. It's A-rated, does have 64% debt, currently offers a 3.1% dividend yield, and trades at a 13 PE. And I'm simply using operating earnings here, as I will throughout this whole presentation. If I was going to examine these companies closely, I want to point out, I would look at all these other metrics, everything from EBITDA, various cash flows, etc., before I made an ultimate decision. But this just gives us a general idea of what these companies are like. Now, one thing I want you to notice that's striking here is you've got this very aberrant normal, quote-unquote, normal PE of 21.9. I want you to notice that PE has no value, if you will, or no practical application since February of 2006. Amgen has clearly traded at valuations significantly below 22 times earnings, but that's because these numbers are distorted. This is one lesson about when you're looking at statistics. The old statistics don't lie, but statisticians are darn liars kind of cliche comes into play. But here you're looking at a company that had 70 PE ratios back in 2000 and PE ratios as low as under 10 by 2011, of course. So that gives us this high average. But I do want you to notice, I'm going to go through here, the company's grown earnings at 13.5% a year. It started paying a dividend in 2011. You can see that by the white line and the light green shaded area. But I also want you to notice that the growth rate of this company changes. But the most important message I want to get across here is how devastating high valuation can be. Here's a case where Amgen traded at a 70, I'm using the peak here, just to be melodramatic. Stock was trading at $75 in August of 2000. If I held that stock all the way through August of 2011, we'll call that 11 years, your rate of return on owning this behemoth technology stock would have been negative. Now, you could easily come to the conclusion that this was a horrible stock or horrible company. I shouldn't say not. It was a horrible stock. You could call it a horrible company. But in truth, if you look at the earnings growth of Amgen over this time frame, it was growing earnings at a very attractive rate. What was wrong was the market was pricing it higher than its earnings justified. And then coming into the Great Recession, when the PEs got down into these lows, 10 times and even single digit digit lows here at the lowest peak, you're looking at it, all of a sudden the market was undervaluing the stock dramatically. But then since we've come out of the recession, and really since the company started paying a dividend, I want you to notice that the price has tracked the earnings, the orange line, very, very nicely during this time. If I shorten this time frame, you'll see that earnings growth here has been about 10.5%. That's not totally inconsistent with the long-term number, but I want you to notice I've got two PE ratio references here. I've got a PE of 15, which is the orange line, and I've got a normal PE of 13.7, or a trimmed average PE, if you will. And what you see here clearly is that in recent times, at least, the best time, the most opportune time, I should say, to be investing in a stock like Amgen is when the stock is trading below the 13.1, normal blue PE ratio line here that we're looking at, or excuse me, 13.7. So, right now the PE is 13.1, and so this would indicate that it would be an attractive time to buy the stock. I do want you to notice that expectations are for negative earnings growth this year. However, a review of Amgen's pipeline, which I would highly encourage you to do, would show that the forecasting for the next year would be 8% growth. So the longer term growth is still going to be rather muted. By the way, this doesn't mean there's not going to be a dividend. This simply means there's no analyst forecasting a dividend. I want you to notice how analysts go from 21 and for 19's estimate, it drops down to 20 for the 2020 estimate, and then down to 12, and then down to 9. I normally don't like to go out more than 2 or 3 years when I'm looking at these calculators. From a normal multiple perspective, looking at the normal multiple for the last 5 years, it's been about 14.5 or 15, if you will. These are close enough. So you're going to get similar results. This stock has the potential of generating double-digit rates of return simply because it is undervalued, not because the company's going to grow, and simply because it does pay a 3% dividend. If I look at its dividend record since they've paid one, they've grown their dividend at a very high rate, but that includes an anomalous growth rate in 2012. Otherwise, it grew at 30, 29, 26, 15, and I'll call that 15. So you might at least want to consider the fact that the dividend growth has been about 15% a year. Anyway, Amgen looks attractive now. It's got good dividend yield. It's a highly rated company. It does have debt, but the debt is, very, very well managed. If I look at the analyst scorecard on how accurate they've been in forecasting this company, they've been extremely accurate, which also tells me that the company gives good guidance. So you might put some credence into these forecasts. Now, again, I'm going to move quicker as I go through to my next example. So let's go ahead and move on, because I wanted you to understand how the charts work, so I tend to take a little extra time with the first company. But now we're going to move into Biogen, which is another biotechnology company. However, similar and different. For one thing, this company has had a very high rate of growth. It's also had very high valuations, and then it's now more recently had very low valuations. Currently trades at around 12 times earnings. I want you to notice the growth rate here. As I change time frames, it goes from, we'll call it 25% down to 19%. I'm going to drop it again. Now, even though this is a 10-year graph, it does include almost 3 years of estimates here. So now I'm down to 17% growth. If I drop it some more, I'm down to 10% growth. And if I look at forecasting on this company, it's expected to only grow at about 4% on average over the next 3 or 4 years. The longer-term trend line growth is even lower at 2.48. So what's happening here is, if you go back to this longer-term perspective, you can see that the company's earnings growth rate is beginning to slow down in more recent years, at least it's forecast to slow down. If that happens, then this stock might not be as attractive as it looks when I look at this long-term perspective here. But anyway, Biogen is more of a growth stock. There's no dividends. It's A- rated, has 31% debt. So moving on, we're going to take a look at another biotechnology company, Celg. And once again, you get this distorted normal PE. So I'm going to chop some time off here. And you can see the company since calendar year 2005 has been a very fast grower. As I drop time off of the graph, you'll see that the growth rate's been 24.8%. Then if I drop more time off of the graph, you can see the growth rate's down to 22%. But the point is, this company, in contrast to Biogen, still has a lot of growth. It's BBB plus rated, does have an awful lot of debt on the balance sheet. I might point that out. From a forecasting perspective, there are a lot of analysts also following this stock, and they do expect double-digit growth over the next 3 years or so. 20% for this year, almost 19% for next year, and over 16.5% for the following year. The longer-term growth rate, however, is expected to be about 23%, and there are 4 analysts who are willing to make a long-term growth rate. Now, when you're looking at growth rates with fast graphs, we do give alternate opportunities to look at other areas. So I'm going to go to Yahoo here, and this is their estimate data, which is a different set of estimates. They do believe growth is going to be about 17.5%. So, that's lower than the 22.7, but it's still higher than what I would say most companies are capable of doing. So I would consider this at under a 10 PE, even though it doesn't pay a dividend, an opportunity to invest in a very fast-growing company. This could generate more capital appreciation than any company I'm going to cover today. My next candidate is actually quite different than what we've just seen. This is an interesting stock to look at, though, because Gilead actually cured hepatitis C. And what was interesting is if I look at their growth rate, you can see the price tracked their earnings growth rate. Then when they came out with their cure, if you will, for hepatitis C, earnings surged dramatically. But then after they've cured all these people, we've seen this period of time where earnings growth has really weakened and fallen over the last couple of years, and it's expected to be very flat going forward. So when you're looking at this company going forward, growth is expected to be virtually nothing. The company needs new drugs in the pipeline. But I really showed this not because I think it's an attractive investment today, although it could be. They did start paying a dividend once this huge surge of growth disappeared. They're yielding almost 3.9%, but be careful with statistics. Not a lot of growth expected on this company going forward. So this is another one that you might want to look at or look deeper into. It's A-rated with 50% debt. For my next research candidate, we're going to look at Milan. I used to call it Milan Labs. Now, Milan's another example of a company that's actually growth-oriented. It's a $14 billion market cap, has about 50% debt, trading at a very low PE of 6. But I do want you to look at where that may have happened. First of all, we can see that the company was paying a dividend and then they cut their dividend. You can see the effects of high valuation and how price tracked earnings. Then coming out of the recession, we had this, surge of really good earnings over all these years, and the price got pretty pricey and pretty high. But all of a sudden now, for the last couple of years, we've actually seen negative growth in 2017. I'm going to shorten the time frame here. We saw no growth in 2018, negative growth again expected for this year before we start to see growth again. So this growth of these recent years, this flattening of earnings growth to where it's gone from being a very fast grower to a 2 or 3% grower is obviously what's caused this normal valuation to get down into single digits. Looking at forecasting going forward, the long-term growth rate is expected to average about 7%. If I look at the next couple of years, negative growth, as I pointed out earlier this year, followed by 7%, followed by 5%. So we've got a very interesting stock here. This would be strictly a turnaround situation. If you believe the turnaround is imminent, then those who like to speculate a little bit might want to take a closer look at Milan. Next, I'm going to go to Abbv. Abbv was spun off from Abbott Labs back in 2013. You can see the company's price has tracked earnings very nicely. The company does pay a very nice dividend. Their dividend growth rate has been exceptional over this time frame. But again, keep in mind, we've got, the first year's growth of dividend was aberrant. But if you look at it, they've been growing earnings quite well. They grew them by, or dividends rather, they grew them by 50% last year alone. So this company, you can see a surge in growth here and a surge in the dividend yield. Stock trades at under 10 times earnings, offers a 5.4% dividend yield. It's A- rated, but it does have a lot of debt. But in this case, the company's cash flows do support both the debt and the dividend. So this is an extremely attractive stock. I'm long on this stock for the dividend opportunity that I see here. I might put that out for disclosure. My next candidate is Allergan. And Allergan's an interesting research candidate. You can see this price-earnings relationship, how price tracked earnings over all these years, whether earnings were going down or rising dramatically. And then all of a sudden we've hit this, more recent time frame here. We've had earnings growth averaging 12%. Now if I drop this time frame, earnings growth's only been averaging 4%. The company did institute a dividend recently, and they're currently offering about a 2% yield. The company has a BBB credit rating and only 26% debt to capital. So when you're looking forward on this stock, it is expected to grow at 4 or 5%. The normal multiple multiple of 15 times earnings, whichever graph you're using here, would indicate this company has tremendous rate of return potential over the next 2 or 3 years, primarily based on not so much growth, but the fact that its valuation is so low. Again, this doesn't mean there is no dividend here. It simply means there's no analyst forecasting one. So again, I wouldn't look much beyond these next couple of years in the forecast here. My next research candidate is another pharmaceutical giant, Bristol-Myers. And going into the historical graph, this is true of a lot of big pharma companies. You're going to see that also with Pfizer a little bit later. These companies, you can see the high valuation. This was a very growthy stock. I don't go back past this. Then earnings kind of faltered, but I want you to see how the price reacted to that earnings growth. However, they have paid a consistent dividend. Now, the dividend has only grown by about 3.5% historically, and more recently it's only been growing at like 2.5% or so, 2.6, 2.7, 2.8. I do want you to notice they did freeze their dividend from 2003 to 2006. But the point is they've consistently paid a dividend. They've never cut it. And so you can see here the salient feature is a very consistent dividend record. Stock is available at a current yield of 3.3%. It's only trading at a 12.4 PE. It's A+ rated with only 26% debt to capital. So I think this particular stock is also very attractive for both the dividend yield, the dividend growth, although it's rather moderate, and the fact that it is expected to resurge itself and grow at 5 or 6% a year going forward. The long-term growth rate, however, is even higher at 9%. This would be one you'd want to check the pipeline to try to validate where that growth might be coming from. My next research candidate, in line with what we just looked at with Bristol-Myers, would be Pfizer company, another large pharmaceutical. And we see some very similar patterns here. We see very high valuations coming into the recession of 2001, which led to very poor stock performance, even though the business did well. They have a decent dividend record in that they've grown it when their earnings were good. They did cut their dividend rather dramatically during the Great Recession, but since that time, they've been increasing the dividend very, very nicely. If I look at what the dividend's done since 2012, it's grown by just under 8% a year. I can expand that out a little bit. It's still averaging about 8% a year. So this company has been a very good performer since coming out of the recession, we've had PE ratio expansion. We've also had the institution of a dividend growth rate again after they cut it during the Great Recession. Stock trades at 13.8 times earnings, offers a 3.5% dividend yield. It's AA rated and only has 31% debt. This might be one that's interesting to dividend growth investors. My next and last research candidate is Perrigo company. It's also a pharmaceutical. This is a very, very interesting story on valuation. This company had some really nice growth back here. Using my scrolling feature, I've gone back from 2002 to 2014. And I want you to notice the company was averaging about 21% growth. They did pay a very small dividend. You can see their payout ratio is very, very low here. But you can see that the price tracked earnings. So the valuation doesn't look quite as crazy when I look at it from this perspective when it was in its growth phase. However, when I scroll back out to the current time frame, you can see that the company, once its growth rate started to change, if I drop this down to like 7 or 8 years, earnings growth was actually negative over this time frame. And you can see the impact it had on the stock price. So when you've got high valuations, high PE ratios, and high growth rates, I think it's imperative that you understand that the stocks become very, very, very vulnerable. This stock, the correction, if you will, was something in the neighborhood of 75 to 80% as a result of a high valuation, which was justified, as I illustrated a minute ago. But then once the earnings collapsed, the stock price collapsed with it. And now we're looking at a stock whose prospects going forward are rather muted, only about 1% growth on the 3 to 5 year growth rate. Growth over the next couple of years might be a little better at 2 or 3%, but this would strictly be a valuation play, 10.5 PE ratio with a 1.5% dividend yield. Anyway, these are the health technology sector companies. I hope you found this video interesting. I'm more than halfway done with this series now. I look forward to talking to you again real soon. Thanks again for watching.